Right, welcome to Investor Talk Show on practical playbooks for South African investors. And today we unpack the REIT rally, cost of capital, and where the bargains are using the South African REIT Association's chart book. And with me is Ian Anderson from Merchant West Investments. He's compiler of the chart book. Ian, great to have you on the show.
Thanks very much, Neil. It's always good to be here.
Yeah, and so just before we dive into the August edition of Chartbook, let's just go a little quick background on the SA REIT Association Chartbook. What is it? And I mean, who compiles it? Where does the data come from? And what it's meant to help investors decide?
Neil, so I've been compiling the chart book for originally the Property Loan Stock Association going back to 2007, 2008. It's compiled on a monthly basis, and it's used by anybody who is interested in knowing what's going on in the South African REIT world. So, literally there is data going back 17, 18 years that people can go and interrogate. We've actually had it used by professors in the UK, in the US, who are doing research on REITs. It's one of the most comprehensive sources of data for REITs anywhere in the world, but it's specifically focused on South African REITs.
Excellent, great. And there's an opportunity for viewers to download the August edition a little bit later. We'll give details. So let's talk a little bit about the August data. I mean, REITs are up 2.4% in August and 14.2% year to date. I mean, is this a proper recovery or a rate relief bounce?
I think it's a proper recovery. We're now starting to see evidence of growth in dividends and distributable income for the very first time in a long time. I mean, obviously there was a bit of a relief or there was a bounce on those statistics after the COVID pandemic when everybody went back to work and people went back into shopping centers. But this is the first true recovery that we've seen in distributable income across the sector, and it's not just one or two segments of the market that are showing this growth. It's pretty much across the board, and you can see it in there's one chart in the chart book that reveals that, and that's that distribution year-on-year distribution growth chart. There's basically it's a bar chart. There is absolutely no bars for a good 8 or 12 quarters, and then suddenly you've got this big step up to around 9.6% in the last quarter. And based on the numbers that we're seeing, that should be sustained at least for the next 4 or 5 quarters.
Okay, excellent. So I mean, are REITs actually paying less on their debt than last year, and roughly by how much? And I mean, and those new share raises, let's talk about Dipula, Fairvest. Are investors backing them at fair prices?
Yeah, so I would say that at this stage, most of the REITs are probably not paying a heck of a lot less on their debt, and that's because most of them have fixed their debt for 3 and 5 years. So there's an anticipation that next year or the year thereafter they will be paying significantly less, and that's because official interest rates are lower. But more importantly, we've seen a significant reduction in bond yields this year. At the start of the year, our 10-year government bond yield was around 10.25%. It's now at 9.25%. That's massive. I mean, that alone means a 10 or 12% reduction in borrowing costs for REITs, because they most of them, when they fix, the cost of the debt will be linked not to the official interest rate, the prime overdraft rate, but the bond market. So we've seen a little bit, and there's some REITs that don't fix their debt, and so they've already started to enjoy the benefits of lower interest rates, but that's still coming, and the market is forward looking. So I think we have already seen a bit of a rally as a result of expectations, and some of our growth expectations are built around much lower interest rates for the new debt that will come on board. So yeah, and I think in terms of raising capital, it's getting a lot easier. These companies are Dapula, Fairvest, Vukile has also raised capital. Spear has successfully raised capital as well this year, and they've all done it at prices very close to where the market is. And on every occasion, it's been oversubscribed. So there is finally we're getting some institutional support again. There's obviously retail investor support. The sector is a lot smaller than it was in 2017, 2018 because values are still a lot lower than when they were. So even incremental support for the sector means that there's strong demand for the shares.
Well, that's good news. So, I mean, if you had $1 billion, where would you put it? I mean, would you pay down debt, buy buildings, develop, or buy back shares? Maybe give us your split today.
I would do all of the above, but I think right now there's an opportunity for these companies to expand their portfolios. So the last 3 or 4 years, the companies have been recycling capital, so they've been selling maybe their underperforming properties, and they've been using the proceeds to pay down debt. And I think that's pretty much done and dusted now. There's a lot of capacity on balance sheets in the South African REIT world. TAC reported results this morning. Their loan to value ratio is all the way down to 25%. So you've got a number of other companies in the same position. Buying back shares is probably also still, it will be value enhancing because these companies are still trading at discounts to NAV, but those discounts have narrowed quite considerably over the last 20 months or so. So it's not as great an opportunity as it was. So I think today the best bet is for these guys to go out there and look for opportunities. And the ones that have raised capital because they are buying properties and property portfolios. So Spear has been very active over the last 12 months. They bought a big portfolio from Emira for 1.2 billion rand in the Western Cape, and then they've done 3 or 4 other transactions this year, which collectively are probably 700-800 million rand. They've got a development pipeline that they want to work on. Fairvest have made some announcements in June, and I've now raised the capital for those acquisitions, and Dapula are also looking to buy a shopping centre and raise capital for that. So the REITs have shifted their focus away from restoring their houses or making sure that their properties are in good shape to now looking at external growth opportunities. And that should provide good growth in distributions going forward.
Absolutely. So where's the growth really coming from? I mean, several REITs guide from 3 to 7% income growth. I mean, is that mainly higher rents, lower vacancies, or lower interest?
All of the above.
Okay.
I think it's little bits of everything. I think lower vacancies is where it starts. So as soon as you've got lower vacancies, you're then able to drive higher market rentals. There's more demand, less supply for that space. Obviously, the interest rate story hasn't quite happened in fully yet, but it will start to happen over the next year or two. I mean, this morning, the 2 companies that have reported, Hyprop and Attack, both of them are talking about double-digit growth in distribution. So we've already moved from 3 to 7 to, I think, Resilient was also up 8 to 10%. Fairvest was 8%. A couple of other companies have now moved to a much higher level, and that's a combination of filling the vacant space, driving through higher market rentals, and the prospect of lower interest rates and therefore lower payments on debt.
Okay, great. So you would say that dividends are pretty safe and getting safer. I mean, with leadership changes, disposals, cleaner balance sheet, solid results. I mean, does this point to steadier dividends ahead?
Absolutely. And I think one other thing and it came through very much in the Growth Point result, and why the Growth Point share price responded so positively, even though the results more or less were in line with expectations, they increased their dividend payout ratio. So they went from 82.5% to 85%, and the expectation is that they'll go to 87.5% next year, and then probably get it up to around 90%, which we would think is the long-term average for the sector. They do want to retain some of their earnings in order to keep putting money back into their portfolios, keep the portfolios new and accessible or make them attractive to new tenants. But the thing that when you retain a lot of that income, you pay taxes. So I do think that now that balance sheets have been sorted out, there's not the same requirement to retain as much earnings, and so the dividends are going to grow not just as a result of an increase in distributable income, but also because those payout ratios are going to start to increase, and Growth Point is obviously the first company to do it. So I think, the dividends are very safe at the moment.
Okay, great. So what would be the one red flag that you would still watch?
And it's unfortunate. I hate saying this, and I say it often. It's governance. The sector, unfortunately, has suffered governance issues. I don't think that all of those governance issues have gone away. There've been some transactions recently where often there are insiders involved on the buying and on the selling side. The sector needs to step away from that sort of activity. It gets quite a lot of negative publicity on social media. People haven't forgotten the resilience saga of 2017. 2018, and some of the other governance missteps that have happened over the years. There are still some companies that are trying to unwind related party transactions. Accelerate is a case in point. So there is still evidence of that, but I think, by and large, most of the companies that are doing well today are doing well because they've sorted out their governance issues, they've sorted out their balance sheets, they've improved the overall quality of their property portfolios. The shareholders that they've got on board are very supportive. They can raise capital in the markets quite easily, and that's a good recipe. And most of the sector is there today, but you still do have to watch out for the governance issues, unfortunately.
Okay, so Ian, what's cheap and what's not? I mean, logistics, retail, convenience, offices, offshore. I mean, where are the genuine bargains today, and what looks expensive to you?
I think the genuine bargain is probably still office, just because of all of the negative publicity around work from home. The fact that that's where the vacancies went the highest, where vacancies still need to be filled in order to get stronger market rental growth. But that's where the most potential is. It might not happen overnight, and it's not happening overnight. But I think if you're a longer term investor, then I do think it's worthwhile looking at the office sector. There's been absolutely no new development there whatsoever. We're seeing development in every other, or development activity in every other area of the property market, but nothing in office. So I think longer term, that's probably where you want to be. I'm always nervous about large shopping centers, big regional malls. As the likes of Checkers roll out their 60/60 offering, it does undermine that big shopping center experience. I think there's still legs in the convenience and neighborhood retail, because people are in their neighborhoods a lot more. A lot of them are working from home 2 or 3 days a week, some people 5 days a week. And so that's still a sector that we're interested in. I think residential, and Octodec specifically, is looking very, very attractive. Probably the cheapest REIT out there. But again, they've got a lot of office and a lot of residential. So there's, again, concerns around the CBD in Pretoria. But I do think, the management team are very focused on getting that right. They have a vested interest in that, because they own the Wapnick family owns so much of the business. So I think for us, it's a small cap. Most institutions are not going to play in that space, and I think for that reason, it's also very underappreciated and underowned, and therefore undervalued. So Octodec is probably the top pick, but bear in mind that for large institutions, you just can't go there. But then I'd also continue to overweight convenience and neighborhood retail. I'd look to have an overweight in office. I'd be underweight Eastern Europe, just because of some of the stuff that's going on in Poland. Russia sending drones into Ukraine via Poland is not a good sign for people with big property portfolios in Poland today.
No, absolutely. No, thanks for sharing that. So let's look at what knocks us back or pushes us higher. I mean, we've seen rates, municipal costs, power, water reliability, also consumer strain. I mean, what's the biggest risk right now? I mean, I mean, the good news is that unlocks double-digit total returns again, huh?
Yeah, I do think it's the cost line, it's operating costs. It's those are often beyond the control of management. So management's usually in control of most things, but not municipal rates, not electricity. Although having said that, we've had very little load shedding over the last 12 to 18 months, and that's been positive for a lot of these REITs because they've put in solar in most properties, especially in things like convenience retail where it's a single story building. It's got a lot of roof space. There's no parking on the roof. And so that whole roof is now just solar panels. And they are still able to sell the power that they generate to the tenants. They sell it to the tenants at the at Eskom tariffs at the rate that Eskom would charge, but obviously they're not drawing that electricity from Eskom. So there's actually there's a very positive return that these businesses are making on the solar panels that they've installed. In some instances, the return on invested capital is well over 20%. So that's been another area of growth for REITs and is likely to continue to be that. But I think municipal rates, certainly we've seen numerous municipalities talking about double-digit increases in rates in order to correct some of the problems that have evolved over time. There's infrastructure that needs to be built. We know that, and the only way that you can do that is to just keep taking more money from your landlords. I also think that if we don't get further rate cuts, that could also be a bit of a problem. I think the market is factoring it in probably at least another 1 or 2 rate cuts this year from the SARB. We're expecting rate cuts from the Fed, and we probably get one this week already. If that doesn't happen, that could be a bit of an issue. But I think the one thing that we haven't seen this year is the property sector's response to those lower bond yields. And we haven't seen the equity market respond to those lower bond yields. So, bond yields down 100 basis points. The listed property sector should have been up over 20%, in my opinion, given the growth that we've seen in distributions, plus the re-rating that we should have had because of lower cap rates, lower discount rates, etc. So I think that's the offset to any negative we may have, as we haven't seen the positive response to our equity from our equity and bond markets, from our equity and property markets to these much lower bond yields in South Africa.
Excellent. Thanks for that analysis. So finally, let's look at a simple 12-month playbook for regular investors. If I'm building a basic REIT portfolio today, how would you split it between steady income and growth?
I think pretty much everybody's going to give you a combination of the two. I think that's what's changed. So there aren't as many businesses that are lagging everybody else or are way ahead of everybody else. I think, if you look at, TAC and Hyprop this morning, for Keeley, Resilient, those are your growth stocks. Fairvest, you could probably put into that bucket. I probably would have an overweight position in growth at the moment, and I would be underweight the guys that are promising sort of 3 to 5%. I think if anything, the growth companies are going to surprise on the upside, and even if those low growth companies surprise on the upside, I don't think it's going to be by a heck of a lot. So right now we're pivoting our portfolios to a more growth orientation, away from the steady income producers. I think it's been a good strategy to have those steady income producers in your portfolio just after COVID, but now you've got certain businesses that are going to grow substantially faster than the sector average, and by substantially in REIT terms, that's like 3 or 4%. It's not 10 or 15%. You need to just clarify that.
Absolutely.
But I think a business, on an 8% dividend yield, growing at 8 to 10% a year is a bargain in the South African market, given that our bond yields are at 9.25 today, with obviously no growth in income. And as we've already discussed, there is a lot more certainty around the income and income growth today than there has been over the last 3 or 4 years. And that's, I think, also very important as well.
Okay, great. So which 2 chart book numbers should I track monthly?
Sure, that's a good question. I do think you need to be looking at that distribution growth because, if that starts to trend down again, that's a signal that, the market's probably gotten a little too far ahead of itself. So I think that's the number that you really need to focus on. I don't think there are too many. I mean, the yield spread is always something that we watch, the difference between bond yields and property yields, where that's going, because it's often difficult to track now because so many of the REITs in South Africa have offshore portfolios, and therefore the values of those portfolios better track global bond yields rather than South African bond yields. So over time, that particular chart has become less relevant or less of an indicator of value or no value in the sector. I think today the main one is that distribution growth. Unfortunately, that one we only publish on a quarterly basis, or it only gets updated on a quarterly basis, but it's the one that I would be watching very, very closely. And if that thing goes into double digits, we're almost at double digits now, then the sector is still very undervalued, in my opinion.
Okay, excellent. Final question. Well, one mistake to avoid now and one action to take this week.
So I think the mistake to avoid, and I'm going to do it at a global level rather than at a company level. I think at a global level, to be underweight REITs now, thinking, oh, well, they did 35% last year and they've already done 15% this year, it's over. I think that's a mistake. We're only now just starting to see the growth coming through. So the what we saw last year, what we've seen so far this year has been more about unwinding those very large discounts to net asset value, unwinding the being priced for bankruptcy, which we had during COVID. So that is now behind us. Looking forward, it's going to be about growth and growth in distributable income, growth in dividends, and that's really ratcheted up. So I think the mistake people can make today is by looking back and saying, "Oh, I've missed the boat." I don't think you have. I think there's still legs to this rally. It's obviously not going to be a 35% return like we had last year, but I definitely think you'll get very good double-digit returns even from this point over the next 2 to 3 years, as long as these companies deliver on those dividend growth expectations, which are now starting to get closer to 8, 9, and 10%, and not 4, 5, and 6%. So I think the thing to do is to start accumulating now. The thing to avoid, or the thing not to do, is to say, "I've missed the boat."
Excellent. I think, Ian Anderson, I think that was terrific insights. Thank you very much for the opportunity. To our audience, if you want to download the SA REIT chart book, you can either go directly to the SA REIT Association website. You can also, we'll drop a link at the bottom of this video as well, which you can get directly to download, and it comes out every month. It's a monthly chart, right? So and subscribe to Investor Talk and our weekly brief at rei.co.za. I'm Neil Peterson alongside Ian Anderson. See you next time. Thank you.